After another tumultuous year, at least in the headlines, the global economy and market proved resilient in 2025, and most major economies are expected to see growth in 2026, albeit the rate of expansion will vary considerably. Lower interest rates, stabilizing inflation, and pockets of fiscal stimulus will contribute to improving sentiment. So with the caveat that volatility is now the norm and tail risks remain elevated, we expect to see a more stable operating environment and increasing opportunities across the real estate landscape in 2026. One theme that will remain in focus in 2026 is cost efficiency. Higher debt and borrowing costs, rising payroll taxes and operating costs, elevated commodity prices, and higher retrofitting and construction costs. All of this will mean a sharper focus on cost management across the real estate value chain. For occupiers, optimizing space utilization and improving operational efficiency will be key priorities. For investors, it will be about focusing on build and property management costs and targeting assets with the potential for income growth to match or exceed inflation. Declining supply across property types will be another key theme. Growing competition for the best quality space will lead to further rental increases in in-demand sectors and locations. Supply shortages will be particularly acute for highest quality office buildings in cities like Tokyo, New York, and London. Logistics and manufacturing facilities will move more into balance as speculative construction falls, while retail vacancy is under 5% in the US and very limited in prime areas across many other markets around the world. For investors, lack of available new development will be good for existing assets that meet tenant requirements and will create opportunities for retrofitting and repositioning some existing assets to fill that supply-demand gap. The top 10 largest markets for repositioning have more than 130 million square meters of space combined at risk of stranding or obsolescence. This includes in cities such as New York, Paris, London, Boston, or Chicago, which will have plenty of opportunities for repositioning of well-located existing assets. Now, this is not an easy game, but we think those that play it well will be rewarded in this cycle. The importance of experience is another key theme we're watching for 2026. This isn't new, but it continues to resonate, and the risk is growing for the spaces, assets, and cities that fall behind. According to our recent survey, employees who rate their current workplace experience highly tend to be more productive and more loyal, and they feel positive even about more structured hybrid policies. Employers and developers have to offer a commute-worthy experience. High-quality fit-outs, the right lighting, acoustics, and technology, the right mix of private and shared spaces, and absolutely amenities and services on site or close by. That last point speaks to the importance of location and the urban environments. More than 2/3 of people we surveyed globally now expect experience to be integrated into the places they live, work, and play, and a growing share will pay for that and even travel for it. We expect the living sector to remain attractive despite some softer segments currently. Institutional markets like the US, Great Depth, Germany, and Japan will continue to be active, with growing demand across a range of markets from Australia to Spain. We have already seen evidence of investor demand returning to the office sector. Corporates have a much clearer picture of actual office utilization now, which will make real estate decisions easier and further boost tenant demand in 2026. As we have discussed, the office outlook will remain highly segmented by quality and location, so the winners will likely be the best stock pickers versus those betting the index. There will also be plenty of opportunities in the logistics sector for investors. Occupier demand will be driven by third-party logistics and distribution as companies look for flexible solutions given the world we live in, as well as strategic supply chain management, e-commerce, and advanced manufacturing. Investors are also paying closer attention to retail, gaining conviction in the recovery and relative attractiveness of in-demand locations in mature markets. AI infrastructure will continue to drive global demand for data centers. Maybe not in a straight line, always up and to the right, but the secular tailwind in this sector is very clear. development finance could present a compelling opportunity for some investors looking to gain exposure to data centers. Beyond data centers, infrastructure is attracting growing investor interest as well. Infrastructure is an attractive option for investors due to its connection to long-term demand drivers, stable cash flows, and relatively low volatility.